The Tax Policy Center estimates that 90% of households would see a tax increase next year if we run off the fiscal cliff with no intervention. How bad can it get, and what can you do to mitigate the impact? Hello, I'm Paul Carroll, CEO and founder of Fiscal Wealth Management, a boutique wealth management firm in the Woodlands, Texas. Just what is the fiscal cliff? At the end of the year, we're going to see a snapback on marginal tax rates to 39.5%, which are the pre-Bush era tax rates. The inheritance tax exemption is going to drop from the current $5 to $1 million, and the tax rate on estates will increase to 55%. Dividend income will be taxed as ordinary income, with effective rates of 43.5% for dividend income for high earners paying Medicare tax. This would effectively roll the clock back on treating capital gains and dividends equally. And it's a shame because it had a significant economic justification to discourage over-leveraging by corporate America. Capital gains rate returns to 20%, which again is effectively 23.8% for capital gains with Medicare tax. So what just is this Medicare tax anyway? A Medicare tax of 3.8% has been applied to investment income with an additional 0.9% on earned income imposed on high earners defined as married couples with 250 in AGI or 200 if you're single. Now, Medicare tax is not imposed on all retirement income, such as traditional IRA withdrawals. But retirement income sources can push you over the threshold so that other investment income is subject to this Medicare tax. Also, the AMT patch is expiring at the end of the year, potentially increasing tax withholding in January, even if it is fixed later in the year. The negotiations to deal with the fiscal cliff further complicate planning. Congress is discussing a cap on itemized deductions, either a top rate of 28% or a dollar cap on allowable deductions. Additional phase-outs are being considered. This may severely impact those with large mortgages, substantial property taxes, and large families. It creates a planning conundrum. Do you accelerate deductions this year to avoid the loss of deductions versus delay the next year to reduce taxable income? Note, Medicare tax is predicated on AGI and not taxable income. Another wrench in the works is the possible reduction in what's known as the 415C limit, which is the total amount of money that can be set aside in qualified retirement plans to possibly as low as $20,000. This was recommended by the Simpson-Bowles Budget Commission and has reared its head since then. Arguably, it's poor public policy because many have an uneven income source, and it will be fought hard in Congress. Finally, there will be a balloon in marginal tax rates for those earning $250,000 to $400,000 associated with the possible phase-out of deductions as one approaches the top 1% of taxpayers. So what strategies do we recommend? We have strategies for individuals and also for small business owners. For individuals, first and foremost, you need to reduce your income in 2013. And the best way, of course, is to maximize the use of 401ks and any other deferred income vehicles that are available to you. Use a health savings account if it's available. This wonderful device can be used to defer income for future medical use. Unused dollars can be rolled over to an IRA when you're 59 and a half. Accelerate deductions to 2012 in case the cap on deductions or increased phase-outs occur in 2013. Prepay your property taxes. Accelerate medical expenses if expected to go over 7.5% of your AGI because the cutoff next year jumps to 10%. Accelerate the recognition of certain gains, a major exception being if you're holding the gains for your estate because those gains would gain a step up in basis and that negates the value of realizing them now. It's a great time, though, to deal with concentrated stock positions. Sell any holdings that you plan to diversify in the next few years. Certainly, market valuations are favorable right now. Consider exercising stock options to avoid the Medicare tax on those options next year. Tax-efficient investing and asset location strategies can add value, too. Consider converting your traditional IRAs to Roth IRAs. You can do a partial or total conversion, and this can be undone by October 15, 2013 if you determine it wasn't optimal. It may be particularly appropriate if you're approaching 70 and a half and you wish to reduce future taxable RMDs. But it's important to consider, are you paying the tax on the conversion with IRA dollars or other dollars? Typically, you don't want to pay tax with IRA dollars. If you have NUA, you may want to revisit your NUA strategy. For many, especially at the major oil firms, given new higher tax brackets, these strategies may only add value if the NUA stock within your 401k is to be held for your estate. Future tax-efficient investments include municipal bonds, rental real estate that generates passive income, oil and gas investments that include tax preferences. Now, charitable contributions will be impacted by these negotiations too. There's the threat of the cap on deductions affecting charitable contributions. However, Congress may reinstate the ability to make tax-free donations of traditional IRA dollars. Estate taxes, the personal exemption, as we discussed, will reverse from $5 million to $1 million, and the tax rate will jump to 55%. So don't die until Congress fixes this. It's likely to be fixed at $3.5 million and a 45% tax bracket, though of course that's not guaranteed. One strategy to protect oneself is to make large gifts. Now, you may be concerned about control. Maybe you don't want to make large gifts to kids who may not be ready yet. A great workaround is set up a grantor trust with rules for future distributions. Charitable remainder trust is also an option that will allow a current deduction and future income for the grantor. If you have numerous heirs, $13,000 gifts from each parent can add up fairly quick. Also, prepay school and/or medical expenses to the extent that they're exempt from the annual gift cap. Additional strategies that we've come up with for small business owners include put your family members on the payroll. This can reduce the income that's subject to the Medicare tax. Also, consider making a Subchapter S election next year to enable you to better control exposure to the Medicare tax. If you're already a Subchapter S corporation, pay an extra dividend this year to avoid paying the Medicare tax on those monies next year. Buy equipment. The Section 179 accelerated depreciation deduction will be reduced substantially at the end of the year. So after talking about these strategies, what predictions or advice do we have? The AMT is going to get fixed. Possibly not in time to prevent mayhem and withholding and delayed programming of IRS computers for the spring tax season, but it will get fixed. The Medicare tax will probably stick. This is a big ticket item. It's a big deal for this administration. The fiscal cliff will result in some compromise, but the bulk of the problem is likely going to get kicked down the road. Depending on the degree of Congress' failure to address the shortfall, long-term interest rates may start to rise, hurting many conservative investors with substantial bond holdings. Be careful about taking actions predicated on a precise knowledge of the future. Hedge your bets with care. Don't let the tax tail wag the dog. Evaluate investment strategies on their own merits first. And of course, get good professional advice. The purpose of this video has been to inform you of the many potential strategies that are available. When we advise our clients, we utilize a consultative approach, working with a team of experts to select an appropriate strategy for each and every client. I don't recommend going it alone. Be sure to consult your professional team before taking action. But act fast. The door closes on many of these strategies at the end of the year. Now, if you'd like a free copy of these recommendations, please click on the link below and I'll send out a checklist to you. Also, if you know anyone who you think would benefit from these tips, please feel free to forward this email video directly, or you could use the link below. Thank you for sharing your time with me.